Okay, let's unpack this. Take a moment and look around the global landscape.
Mm-hmm.
It feels pretty complex right now, doesn't it?
Uh-huh.
We're talking about trade conflicts, military conflicts, supply chain disruptions, financial markets, well, bouncing all over the place.
Yeah.
The sources we're diving into today actually use a phrase for this. They call it an ambiguous world order.
It's certainly a challenging backdrop, yeah, especially
Yeah.
for a company operating on a global scale, building massive projects.
Exactly. So our mission today is to look at how one major player, the Indian multinational conglomerate Larsen Toubro, or L&T, is navigating this complexity.
Right.
We've taken a deep dive into their recent Q4 and full financial year 2025 earnings call, transcript, and presentation.
The source material itself.
Yep. We're going to extract the absolute most important nuggets, the surprising facts, and, the key insights to give you a shortcut to being well-informed on their performance and strategy.
And L&T is primarily known for its large-scale engineering, procurement, and construction, or EPC projects. Big builds. They also have significant high-tech manufacturing and services businesses. So think of them as builders of fundamental infrastructure, energy facilities, and increasingly high-tech components, too.
So their performance really gives us a window into global capital spending, especially in their main markets.
A valuable window, absolutely, particularly in India and the Middle East, which we'll get into.
And looking at those headline numbers for the full year ending March 2025, frankly, they're pretty impressive, especially considering that ambiguous world order we just mentioned.
Absolutely. Group order inflows for the full year hit Rs. 3,566 billion. Now, that's a strong 18% growth year on year.
18% is solid.
It is. But the key insight here, they surpassed their own order inflow expectations for the second consecutive year.
Okay, wait. 2 years in a row, they beat their own forecast.
2 years running. Doing that once is great. Doing it twice in this kind of environment, that really stands out.
That speaks volumes, yeah. And are they translating those orders into actual revenue quickly?
They seem to be. Revenues came in at Rs. 2,557 billion. That's registering a solid 16% growth year on year.
16% revenue growth, okay.
And management points to the large order book they've built up and good execution momentum as the drivers behind that. They're getting the work done.
And that order book itself is reaching record levels, right? I saw that number.
A record-breaking Rs. 5,791 billion by the end of March 2025.
Wow.
That's up 22% year on year. And this is crucial because it provides significant multi-year revenue visibility.
Right, they know where the work's coming from for years.
You got the projects lined up, yeah.
And beyond just, getting orders and revenue, their financial health metrics saw some notable improvements too.
Yes, and this is a key insight into their operational efficiency. Their group net working capital to revenue ratio.
Okay, NWC to revenue.
Came in at 11% in March 25. Now, they specifically highlighted this as the best we have reported in the last 10 years.
That's in a decade.
Yeah.
What does that really mean for them?
Well, net working capital essentially measures how efficiently a company is managing its short-term cash tied up in operations. A lower percentage, like 11%, often means better cash flow.
Ah.
And they attributed this improvement directly to strong customer collections, getting paid on time.
That metric is incredibly important for a business with such long project cycles. Makes sense. And their profitability relative to shareholder investment also improved, ROE.
Correct. Their return on equity, or ROE, improved to 16.3% for FY25. That's up 140 basis points from the previous year.
So 1.4% improvement.
Yep, 1.4%. It indicates they're becoming more profitable from their equity base, generating better returns for shareholders.
And speaking of shareholders, there's a dividend of Rs. 34 per equity share.
Right.
So, okay, strong top-line growth, a massive order book giving future visibility and improving financial efficiency. Quite a year indeed.
It certainly was. Now, let's go back to that big picture, the ambiguous world order.
Right, the complexity.
How do they navigate those seismic shifts, as they put it? The sources highlight that L&T is actively mitigating risks while, at the same time, capitalizing on opportunities.
And a core part of that strategy seems to be leveraging, surprising resilience in their primary geographies.
Yeah.
Where they do most of their projects in manufacturing.
That's the critical point. One of those key geographies is India.
All right.
They're seeing robust consumption continuing, significantly supported by the government's ongoing capital expenditure spending on infrastructure. That continues to be a big driver.
Makes sense. What else in India?
Manufacturing capacity utilization is high, and both bank and corporate balance sheets domestically are looking healthy. So the foundation there seems solid.
And the other major resilient market mentioned was the Middle East.
Precisely. Especially the GCC countries, think Saudi Arabia in particular, this region continues to invest heavily in physical and digital infrastructure. Big projects.
Still building out.
Yeah, and they're also strategically monetizing their oil and gas assets. But importantly, they're aggressively pursuing energy transition and industrialization goals, too.
So a mix of traditional and new energy focus.
Exactly. And L&T sees these initiatives as providing attractive growth opportunities, which is helping them win those significant international orders we talked about.
Okay, so even with global chaos, their main markets are providing pretty solid ground for growth.
For their core project and manufacturing businesses, absolutely. It's a bit of a different story, though, for some other parts of their portfolio.
Oh, like what?
Well, their financial services business, being largely focused locally within India, is somewhat insulated.
Okay, domestic focus helps there.
But their IT and technology services business saw more subdued growth. That segment's performance directly reflects the softer global macroeconomic environment, where IT spending in developed countries has slowed down a bit.
Right, that global tech slowdown is hitting that part of their business.
Yeah.
Okay, let's dive a little deeper then into some of the specific business segments and the strategic moves they're making. Infrastructure is, of course, enormous for them.
It is a huge part of their business. This segment saw strong order inflows, with a particularly high share coming from international markets.
How high?
Get this, 61% international for the full year FY25, and a remarkable 71% just in Q4 alone.
71% international in one quarter. That's a significant shift.
It really is. Shows where the momentum was, especially towards the end of the year.
And they're changing how they structure parts of this segment, right? Something about renewables.
Yes, good point. Effective September 1, 2024, they've carved out a separate renewable energy subvertical.
Okay, spinning it out internally.
Essentially, yeah. It comes out of their power transmission and distribution business and is designed to give it increased focus and autonomy to better chase opportunities in the rapidly expanding renewable energy space.
Makes strategic sense.
Yeah.
And the pipeline for infrastructure projects looks massive.
Huge. Their prospect pipeline for infrastructure in FY26 is standing at Rs 9.64 trillion.
9.6 trillion.
Yeah, covering a wide range of potential projects from heavy civil, transportation, to renewable and water. Lots of potential work there.
Okay. Moving to energy projects, hydrocarbon has been a real strong point recently.
Very strong. For the second year in a row, the hydrocarbon segment crossed Rs 600 billion in order inflows in FY25.
600 billion again.
Yep. And this was significantly boosted by international wins, notably including an ultra-mega offshore order from Qatar Energy.
Ultra mega, that certainly sounds like a substantial project. I wonder what qualifies as ultra mega.
It definitely implies a very large scale and value, yeah. And like infrastructure, they're also restructuring hydrocarbon. They're carving it into distinct offshore and onshore verticals effective April 1st, 2025.
More specialization again?
Seems to be the theme. Focus. Within the broader energy umbrella, their Carbon Light Solutions business also achieved its highest ever order inflow in FY25.
Carbon light, what do they do?
They primarily deal with things like boilers and turbines for power plants. They secured 2 significant orders from NTPC in India.
Ah, so supporting conventional power too.
Exactly. This is supported by the Indian government's continued focus on thermal capacity to ensure baseload power generation, even as renewables grow.
Got it. And the other exciting area within energy seems to be green and clean energy.
This is definitely an area they're leaning into hard, seeing significant emerging opportunities, particularly in gas to power internationally. That's now managed under the L&T Energy umbrella.
As to power, interesting. What else in green? Hydrogen.
Yes, a major highlight mention was receiving a significant incentive under the government's Production-Linked Incentive, or PLI, scheme for green hydrogen production.
Ah, the PLI scheme. How much are we talking?
They received approval for an average incentive of Rs 11.11 per kilogram for a capacity of 90 KTPA, that's kilotons per annum.
90,000 tons a year capacity.
Right, and that incentive could be worth around Rs 300 crores over 3 years. They've also secured land allocated at Kandla Port in Gujarat for a production plant under a 30-year lease.
So they're not just talking about energy transition, they're putting real investment behind it. Building a plant.
Absolutely. Boots on the ground, or maybe pipes in the ground, and you could see that reflected in their prospect pipeline for green and clean energy.
How so?
It's seen huge growth for FY26. It jumped from Rs's 0.10 trillion to Rs 0.70 trillion year on year.
Wow, a seven-fold increase in prospects there.
Yeah, primarily driven by those international gas-to-power opportunities.
Okay. What about high-tech manufacturing? Any key developments there?
A couple of notable points: they made L&T Special Steels and Heavy Forgings, or LTSSHF, a wholly owned subsidiary. They bought the rest of it.
So brought that fully in-house.
Yep. And they secured a repeat order for the K9 Vajra artillery platforms for the Indian Army, highlighting their continued presence in the defense sector.
All right, the defense side. And the services segment saw some strategic moves as well, particularly through acquisitions, it seems.
Yes, they were active here. L&T Technology Services, LTTS, acquired a company called IntelliSwift.
What does IntelliSwift do?
They bolster LTTS's offerings in software product development, digital integration, data, and AI, adding tech capabilities.
Makes sense.
Any others? Their data center business increased its stake in E2E networks. L&T Semiconductor Technologies acquired Siliconch Systems.
Semiconductor tech, that's interesting.
Yeah, Siliconch is described as a startup with patents specifically in power semiconductors, so pushing into chip design.
And L&T Finance.
L&T Finance made a strategic entry into the gold loan business by agreeing to acquire the gold loan portfolio of a company called Paul Merchants Finance.
Adding gold loans to their financial services mix.
Exactly. And another point on L&T Finance, they actually hit a major internal target ahead of schedule.
Oh, yeah. What was that?
They achieved 97% retailization of their loan book. That was a key strategic target for them, and they hit it well ahead of their FY26 deadline.
Good progress there. Lastly, let's touch on development projects. We've seen them divest some assets here in the past.
That's right. They completed the divestment of their toll road business, L&T IDPL. That's done.
So what's left in that segment?
The main remaining assets are Nabha Power, which is a 1,400 milliW coal-based power plant that brings in most of the segment's revenue.
Okay, a significant power asset.
And the Hyderabad Metro.
Yes, the Hyderabad Metro. That seems to be a complex situation financially. What were the key details mentioned there?
It definitely requires significant attention, as they put it. While their Q4 FY'25 results for the Metro showed an improvement compared to the same quarter last year, it still operated at a loss.
Still losing money, but less.
Right. And that Q4 improvement was significantly aided by a one-time gain from monetizing a real estate parcel.
Selling off land nearby.
Exactly. What they refer to as TOD, or transit-oriented development monetization. Selling or developing land near the stations to generate funds.
So the path to making the Metro financially viable depends on several pieces falling into place. It's not just about ridership.
Exactly. They're pursuing several levers. They expect debt refinancing in FY26, which should help reduce those heavy interest costs.
Okay, lower finance costs.
Fare revisions are planned soon, which could increase revenue.
Raising ticket prices.
Presumably. They are actively working to improve ridership through better last-mile connectivity solutions, making it easier for people to actually get to and from the stations.
Makes sense. Anything else?
And crucially, they are focused on securing the remaining interest-free government loan. There's apparently Rs 2,100 crore still pending release from the government.
2,100 crore. That's a big piece of the puzzle.
A very big piece. Management stated pretty clearly that achieving full viability for the Metro is expected to take a couple of years and receives attention on almost a daily basis.
Attention on almost a daily basis?
Yeah.
That really gives you a sense of the focus that specific asset requires from top management.
It certainly does. Now, okay, let's shift to looking forward. Their order prospects pipeline is, well, it's absolutely massive.
It jumped significantly. I saw the number, Rs 19 trillion for FY26. 19 trillion.
Yeah, it's a sharp 57% increase year on year compared to Rs 12.1 trillion they had projected for FY25.
57% growth in the potential work out there. Where's that huge increase coming from?
It's primarily attributed to potential opportunities in infrastructure, hydrocarbon, carbon light, and that fast-growing green and clean energy business.
Okay, the core areas plus the new energy stuff.
But here's where we find a really interesting strategic insight. A bit of a disconnect, almost.
Ooh, what's that?
Despite this staggering 57% increase in the potential prospect pipeline, their guidance for actual group order inflows for FY26 is a much more modest 10% growth.
Hold on, the pipeline of potential projects is up 57%. But they're only guiding for actual new orders to grow by 10%.
Exactly.
Yeah.
That's the tension.
That's a big discrepancy. Why the difference? What's the thinking there?
Management provided a pretty clear rationale. First, while the robust pipeline is obviously a very positive sign, they are mindful of those global geopolitical situations we talked about.
The ambiguous world order again.
Right. It can cause potential customers to delay final investment decisions, even on projects that seem necessary. So, caution.
Okay, external uncertainty is one factor.
What else? Second, they are operating from a very large existing order book base already. They emphasize the need to be selective about which new projects to pursue
Selective. Why?
to improve their return on equity metrics. They mention sometimes walking away from projects that don't meet their internal profitability criteria or risk profile. It's not just about volume.
Focusing on profitable growth, not just growth at any cost.
Precisely. And third, they mention that capacity augmentation, building up their ability to execute even more work, takes time. You can't just double your execution capacity overnight.
Right, practical constraints.
So the 10% guidance is presented as a realistic, maybe even conservative estimate to start the year. It acknowledges the external uncertainties and their internal strategic priorities around profitability, selectivity, and capacity.
So it's not necessarily a lack of confidence, but more prudence.
That's how they frame it. They did also mention it could be revised later in the year if conditions or their win rates turn out better than expected.
Okay, so it's a conscious strategic choice, balancing the huge potential out there with prudence, profitability goals, and real-world execution capacity.
Exactly. It reflects a management philosophy focused on quality of orders as much as, or maybe even more than, quantity right now.
Makes sense.
Right.
Now, looking at their current order book, where is the work actually located?
Right now, it's 54% domestic, so just over half in India, and 46% international.
Nearly half international. And within that international
It's a
portion,
significant concentration. 81% of that international book is located in the Middle East.
81%. So the Middle East is absolutely critical for their international business.
Hugely critical, and that concentration in the Middle East perfectly matches where that big prospect pipeline growth is coming from, too.
The potential work aligns with where they're already strong.
It absolutely does. They said approximately 80% of the R's 11.7 trillion international prospects identified in the pipeline come from the Middle East.
So they're doubling down where they have strength.
Yeah.
How confident are they about actually executing all this international work?
Management expressed confidence, especially in core markets like the Middle East and West Asia. They see it as familiar territory.
They've been there a long time.
Decades. They have a long history, established infrastructure, strong local teams, and crucially, strong, trusted client relationships.
And they even mentioned that this trust sometimes helps them win those larger, ultra-mega projects, even if they aren't necessarily the absolute lowest bidder. That's interesting.
Yes, that deep-seated client trust and their execution track record in the region seems to be a real competitive advantage, allowing them to sometimes compete on factors beyond just price for the biggest, most complex jobs.
And they're avoiding riskier areas.
They specifically mentioned they've strategically decided to defocus from potentially riskier geographies, citing some African countries as examples where maybe payment cycles or operational challenges are higher.
Focusing resources.
Okay.
Is their large hydrocarbon pipeline sensitive to oil prices? If oil drops, do those projects disappear?
It is sensitive, but mainly for the final decision to award new projects, less so for projects that are already underway.
Okay, so it affects future orders more than current work.
Correct. They noted that if Brent crude prices were to fall significantly, say below USD 55 per barrel or West Texas Intermediate WTI below USD 50, it could potentially delay customer decisions on new hydrocarbon projects. Big investments might get paused.
55 Brent seems like a key level to watch then.
Potentially, yeah. However, they emphasize they are dealing with top-tier national oil companies and major customers who have strong payment records, even during challenging times like the COVID period.
So the existing work is pretty secure.
They seem confident, and they stated that funding lines are generally in place for the existing international order backlog. The financing is sorted for the work they have now.
Okay. What about domestic order inflow back in India?
Yeah.
You said the order book is 54% domestic, but it sounds like the recent growth has been more international.
That's been the trend, relatively speaking, yes.
Well,
The growth momentum has definitely skewed international lately.
why is that? What are the challenges domestically?
Well, the challenges they mention often include smaller average order sizes compared to those ultra-mega international deals,
Right.
and sometimes less stringent pre-qualification criteria compared to international tenders. This can lead to more bidders, intense competition, and sometimes unsustainable pricing from competitors just trying to win work.
a race to the bottom on price sometimes.
That seems to be the implication. L&T has stated they sometimes choose to walk away from bids in certain domestic areas, like water projects or thermal power historically, if the terms aren't right, the funding isn't secure, or the pricing just gets too aggressive to be profitable.
So more selectivity domestically, too.
Yes. Interestingly, though, the value of the domestic prospect pipeline has actually increased year on year, from about Rs 6.8 trillion to Rs 7.3 trillion. So the potential is growing domestically, too.
But the conversion into actual orders is tougher,
Well,
or they're being more picky.
Exactly. The growth in overall order inflow for FY26 is still expected to be biased towards those larger international opportunities, despite the growing domestic pipeline.
Understood. And defense manufacturing was mentioned as a potential growth area domestically.
Yes, it's seen as a potential opportunity, definitely driven by increased government capital expenditure in India and the big focus on Make in India or indigenization.
Right. Building defense equipment locally.
Correct. However, they caution that its overall contribution to the entity level, while growing, is still expected to remain relatively limited compared to the sheer scale of the infrastructure and energy segments in the near to medium term. It's growing, but from a smaller base.
Got it. Okay, let's wrap up by talking about their financial strength and future vision, especially around margins and investments. You highlighted that significant working capital improvement earlier.
It was indeed significant, yeah. That NWC revenue ratio improving to 11% was a major positive, and they directly linked it to stronger customer collections, getting the cash in the door.
And that helps cash flow.
Absolutely. This efficiency also contributed to very robust free cash flow generation for FY25. The number they gave was Rs 174 billion.
174 billion in free cash flow.
Yeah, that's a substantial amount of cash generated after covering operating expenses and capital expenditures. Gives them a lot of financial flexibility.
Huge flexibility. And what's the outlook for margins, particularly for that core projects and manufacturing portfolio? Are they expecting improvement?
They are targeting an 8.5% margin for FY26 for this portfolio, so aiming for some stability or slight improvement there.
8.5%.
But here's an important nuance. Management noted that the full margin benefits from executing those recently won very large international hydrocarbon projects. Those aren't expected to fully hit the P&L until FY27.
Ah, so there's a lag. The big profitable jobs take time to flow through the numbers.
Exactly. It takes time to execute those massive projects. They are also pursuing internal efforts to improve margins, through technology adoption, better project management, optimizing sourcing.
Finding efficiencies.
Right. Including, interestingly, exploring opportunities to source materials perhaps from China, given the current global trade dynamics and tariff wars. Apparently, some Middle Eastern customers are open to this if it helps project economics.
Navigating the trade landscape for better costs. What's the overall margin goal?
The aim, they said, is to operate consistently in the 8–10% margin band, especially in the Middle East, while also making sure they invest in building local capacity to handle the workload.
Okay, 8 to 10% target range.
Yeah.
And the overall ROE target remains in focus. They want to get higher than the current 16.3%.
The aspiration is still to reach an 18% return on equity by the end of the current strategic plan, which finishes in FY26.
So they have about a year to get from 16.3% to 18%. How?
Well, the key levers they mentioned include further enhancing capital productivity, getting more revenue out of their assets, although they've already made good progress there, so maybe less room to improve further.
Okay.
And achieving better performance and profitability from their services businesses, like LTTS and L&T Finance. Those need to contribute more to the bottom line.
So better returns from services is key to hitting that 18% ROE.
Seems to be a major part of the plan. They also mentioned that a previously considered share buyback plan, which could have helped ROE, was apparently impacted by changes in tax regulations in India.
Ah, okay. Tax rules got in the way of a buyback. And quickly on asset monetization, is there much left to sell from that development project segment after the toll roads?
Not a huge amount positioned for immediate sale, it seems. Much of the planned divestment, like the toll road business, is complete. The Hyderabad Metro, as we discussed, is currently very challenging to sell given its financial performance. Needs the turnaround first.
Makes sense. And Nabha Power, the coal plant.
Nabha Power, which they described quite positively as a Rolls-Royce plant, implying it's efficient and well-run, is performing adequately. They said it could be of interest to buyers if market conditions were more favorable.
But no urgent push to sell.
Doesn't sound like it. The current focus seems to be more on investing the capital they do have into those new growth areas rather than aggressively pushing for a divestment of Napa Power right now.
Which brings us back to that theme of investing in new areas for future growth, shifting focus.
Yes, exactly. Capital is being actively allocated to what they call newer business areas. Think green energy, green hydrogen, data centers, and that semiconductor design capability they acquired.
So planting seeds for the future.
Definitely. But they were clear that significant contributions to group returns from these specific investments are expected to become more substantial, not really in the immediate FY26, but more in the next strategic plan period.
Okay, so looking out to FY27 through FY31 for those new bets to really pay off.
That seems to be the timeline they're working towards.
So wrapping all this up then, what's the overall outlook and focus for L&T in this coming year, FY26?
Well, despite that backdrop of global uncertainty, their view is that the Indian economy is expected to remain resilient, supported by those strong domestic factors, government spending, healthy balance sheets.
Okay, India looks solid.
And the GCC countries in the Middle East are also poised for continued growth and investment, providing the bulk of their big international opportunities.
So the two key regions look supportive.
Right. L&T's core focus for FY26, therefore, will be on timely execution of their massive existing order book, getting that work done efficiently. Also preserving liquidity, optimizing resource use.
Do the basics well.
Exactly. While remaining, as they put it, cautiously optimistic on chasing those new opportunities and staying dedicated to enhancing shareholder returns, like hitting that ROE target.
And the roadmap for that next strategic phase, FY27 onwards, that's still being developed.
That's right. They mentioned it's currently being worked on, and they plan to communicate that more fully probably around the time of their Q4 FY26 earnings call next year.
Okay. So the core story here really is of a massive traditional infrastructure and engineering player successfully navigating a truly complex and ambiguous global environment.
Yeah, that ambiguous world order seems apt.
And they're doing it by leveraging the surprising resilience in their key core markets. India and the Middle East focusing intensely on strong execution and making these clear strategic moves to grow future-focused segments like green energy and digital infrastructure.
They've absolutely built a remarkable foundation with that huge order book and that even bigger prospects pipeline. It offers significant future visibility, no doubt.
But
the insight, I think, comes from their guidance. They are taking a measured, selective approach to converting that massive potential into reality. It's this balance between ambition on one hand and prudence, profitability, and efficiency on the other.
it's fascinating, isn't it? You have a company with such deep roots in traditional heavy-duty engineering, building bridges, power plants, refinery.
The backbone of industry.
Exactly.
Yeah.
Yet they're clearly making significant bets now on the future economy, green hydrogen, data centers, semiconductors. It leaves you with this thought, maybe. How might this fundamental shift in focus actually change the identity of this industrial giant over the next decade? And what does that signal, perhaps, about the kind of adaptation required for large-scale industrial companies globally to really thrive in this rapidly changing world?
That's a great question to ponder. A fascinating evolution to watch, for sure.